Tesla is the first name of the Magnificent Seven to report earnings this season. That report out next week. To discuss how you can cash into the Mag 7 without betting on individual names, we've got Matt Kaufman, who is the Calamos Investments Senior Vice President and Head of ETFs, as part of this week's ETF report brought to you by Invesco QQQ. Great to have you here with us. So, as we're getting ready for the time of earnings season that typically, at least over the past several earnings cycles, has attracted a lot of fanfare in those Mag 7 names, how can people make sure and investors make sure that they're not just doing stock picking, but perhaps doing some basket packing?
Sure. Hey, Brett, thanks for having me. Good to be back. We're seeing that Mag 7 trade, as you said, it's continuing to drive strong returns overall. Year to date, that group of 7 stocks, you talk about Tesla. I think Tesla, from a market cap perspective, has moved down the list a little bit, but still is considered one of those Magnificent 7 stocks. But that group of 7 is up about 40%, as a group. We're seeing the other 493 stocks within the S&P 500 start to perform as well, and starting to come back and drive some of that return. But overall, the Mag 7 is still accounting for a significant portion of that S&P 500 return. It started in the early 2020s, around 2021. We saw the Mag 7 account for about 33% of the overall return of the S&P. Today, it's similar. We're seeing about half of that return. If you look back maybe 2010, 15 years ago, the makeup of this Mag 7 or the top stocks was remarkably different. It was a lot more diversified. You had ExxonMobil, you still had Apple, and Berkshire Hathaway was in that top 10 there, but you had names like energy names, you had J&J, you had consumer type names. So it was a well diversified mix. But now we're starting to see that Mag 7, is largely tech heavy. The S&P 500 is becoming, over 30% in information technology. So we've always had this mega cap exposure, concern, whereas now we've got mega cap exposures, but also sector concentration. And so we're seeing a lot of folks move into strategies that can give access to these Mag 7 names if they continue to run, but are also looking to do it in a defensive way.
And so with that in mind, what type of continuity and inflows are you tracking and are you seeing into this theme, given how far it's run so far?
Yeah, we're seeing people move into the broad markets still. They want to capture that growth if it continues, but we're seeing movement into like equal weight versions of S&P 500, NASDAQ 100 as well, for folks who want that performance. If the leadership in the Mag 7, stops continuing going forward, maybe the innovation doesn't keep up at the same pace, then you would want exposure to those other names as well. And so we have a fund called CANQ, CANQ, that offers exposure to a lot of those top names in the NASDAQ, but uses options in order to do that. So you have a very specific spend on options, and then there's a bond foundation underlying that portfolio to provide defensive risk management should those names not perform. But there's exposure to the Mag 7 names, and then there's also exposure to the equal weight QQQ as well.
How are these ETFs performing against the broader market, I wonder? I mean, we were talking at the top of the show about the dozens, about 4 dozen nearly record highs that we'd seen in the broader markets this year for major averages.
It does seem like it just continues to go higher and higher. We have that rate cut, and we continue to see the S&P move higher. We had that jobs report come out a couple weeks ago, which provided a little bit more volatility in the market. But CANQ has held up steadily, has uncapped upside exposure using call options on those single name stocks. And that has kept pace, pretty well with the market, but provided a bond floor along the way. And so we're seeing a lot of folks moving into these options-based strategies, which really allow you to control the exposure that you want to these Mag 7 names and to others.
And so with that in mind, what is the core theme over the course of this earnings season that you imagine for the Mag 7 would continue to propel these names to outperform versus the other 493 in the S&P 500?
Yeah, I think the core theme here, we're gonna need to see capital expenditures from these Mag 7 names. We need to see a continued pace of innovation, which we're seeing that happen. But in order to keep that up, I think that's the main theme that investors are going to want to see to keep up with this swift pace of growth. And I think there's questions of how long it can be sustained. We've been having those questions for a couple of years now, and it continues to go higher and higher. But as that happens, I think people are looking at risk managed ways to maintain exposure to these names so that they don't lose sight of the growth, but do it in a smart way.
Matt, I wonder what your weighting strategy within the ETFs at Calamos has been versus some of the others that are on the market.
Sure. I mean, if you're just owning a broad market, as I said, right now, if you buy the S&P 500, you're going to be 30% exposed to information technology. If you look at the NASDAQ 100, it's about a 60% exposure. And so the way that we look at that is, let's take a look at the single names inside the NASDAQ 100 that might be driving some of this performance, and let's access those in a risk managed way. And so that allows you to diversify your risk out away from the sector concentration that we're seeing take place in those broad markets. The S&P 500 is a multiple trillion-dollar complex, and right now, you're seeing people really exposed to that sector concentration, and so I think it's something to watch out for.
Matt Kaufman, who's the Calamos Investments Senior Vice President and Head of ETFs, thank you so much for joining us as part of this week's ETF Report, brought to you by Invesco QQQ.